So oil is up today, staying above $60, but it's a far cry from where it started the year, above 80. So what's next? Rebecca Babin is the senior energy trader at CIBC Private Wealth and joins us now to talk some more about this. Rebecca, thanks for joining us today. Look, crude has come up from the lowest low, but is there an even lower floor that you see?
So I think that test of 55 is a pretty good floor for crude right now. You know, we tested it a couple of weeks back when the kind of tariff conversation was hitting its kind of maximum fear, where we saw this kind of reset of where demand is likely to fall out this year, which the market had been anticipating 1 million barrels a day of demand growth. And when we saw the kind of tariff reaction, everyone has kind of lowered their estimates back down to 500,000 barrels to 600,000 barrels a day of demand. And I think 55 is supportive of that kind of assumption. The reaction we're seeing today is obviously more on the supply side. There's commentary out of Secretary Treasurer Babin that the U.S. would go back to maximum pressure on Iran if the talks that started last week do not come to fruition and the negotiation stalls. There was some headlines also that Iran is saying we can't continue to move these goalposts if you want us to, negotiate. So the fact that those are kind of falling apart is what's driving the rally right now. I do think the demand side of the story is much more kind of sensitive. And if we saw an improvement in demand, we'd see a really nice rally. And if we see further stalls in these tariff headlines, I think 55 is initial support. I think 50 is a very strong support level, but my assumption is we hold 55.
Some of the uncertainty is from the trade war. Some of it, of course, is from OPEC and what its plan is. It's been opening the taps. And I'm wondering if it's clear what to expect from OPEC next.
It's definitely not clear. So I think that's a great point. OPEC has kind of shifted its strategy over the last month. It went from being a market stabilizer and taking barrels off the market when there was price weakness or uncertainty to wanting to kind of maximize its market share or improve its market share. I think maximize might be an overstatement. So I think that shift has really kind of shaken the confidence of many investors of where that floor is in crude. I tend to think that their actions last month to kind of increase their production cut unwinds more aggressively was more a message to the cheaters within their own group that they are going to actively try to punish them and that those members need to fall into line. I don't think they've actually going to try to flood the market or press crude below 50 to try to wipe out U.S. shale. I think they're trying to get their members back in line. I also think they know that helps them politically with Trump. Now, is there a fruit from that labor? That's yet to be seen. So I think that uncertainty does create an overhang, however, and I think that's a really relevant point when we look at rallies. These headlines today, actually in a different environment, would have been a 3-5% move in crude. If we talk about maximum pressure on Iran that has 1.8 million barrels of exports going out, and you could lower that to 500,000 barrels, take 1 million barrels off the market, that would have been a pretty big move in crude in a different environment. But knowing that Saudi Arabia has maybe changed the playbook a little bit is capping those upside rallies that we see on supply-driven events from Iran. And of course, the macro environment, which is very heavy today, also playing a big factor in kind of what I would call a very subdued move considering the headlines.
Okay, so you mentioned the outlook and the revised demand forecast from different sources. I'm just wondering, with the talk of a recession, and we're hearing from the Bank of Canada, we're hearing from the U.S. Federal Reserve as well today, how would a recession then revise what's already been revised?
That's a great question. So what I think has been revised into the new numbers from the IEA, and to a much lesser extent OPEC, is an 80% chance of a U.S. recession. So obviously there is further downside if the U.S. goes into a recession or if we get a much bigger global recession. So 500,000 barrels a day, I think, kind of factors in stronger OPEC output and an 80% probability of a U.S. recession. I think we could see that number grind lower, closer to maybe 200,000 barrels a day of demand growth, so shaving another 300,000 barrels off if a U.S. recession is indeed at 100%. And then again, if we get a really long, prolonged and deep global recession, you could see demand growth fall to zero. I think that's a pretty extreme scenario. That would be taking 1 million barrels of demand growth off the market. Typically, the back of the envelope math that crude trader use is, 1% fall in global GDP equals a 1% decline in global crude demand, which is approximately kind of $8 off the price. So that's the quick math, and a 1% hit to global GDP is a pretty big number. So that's where we lose that 1 million barrels of demand growth.
So what are you saying then to investors when there's just so much going on and things are changing quickly on almost every front? What are you saying to your investors, or how are you advising?
So I think the thing to keep in mind is the crude market has priced in a pretty bad scenario, right? So 80% chance of a probability of a recession in the U.S., an increase of supply from OPEC, pretty much not pricing in any sanctions pressure or much sanctions pressure in Iran or Russia. So the way I look at it is, at this point, if we get these really extreme sell-offs and nothing has changed on the tariff conversation, right, then I think you can buy those dips. I don't think you necessarily are going to hang on for, an extended period of time. You need to be kind of more nimble than you might have been in the past. But I think in this environment where we're at with the information you have, I'm comfortable buying those dips closer to 55. But I think anytime we get in WTI, I think anytime you get closer to 75, you start trimming that and trying to taking those trades off.
Rebecca Babin, I've got to leave it there.